Gold hits all-time highs, Bitcoin over $10,000, and the United States dollar is falling out of bed. What should you do? Should you buy, hold, or sell? I'm going to explain this to you in 3 simple, fast steps. Step number 1, we have to answer the question that we always start with when we're looking at a specific asset to buy. That's asking if it is cheap or if it is expensive. We start with a gold chart adjusted for inflation going back to 1970. It goes from 200 an ounce all the way up to 2,400. Prior to 1970, around 200. Then when Nixon takes us off the gold standard in 1971, goes up to $1,000, then down to about 600. Then of course in the late 1970s and 1980, it goes parabolic up to almost $2,400 an ounce when you adjust for inflation. Then Volcker comes in and puts the brakes on inflation, jacks interest rates up to almost 20%. Gold comes crashing down till we hit a low in about 2000. Then we have a commodities bull market. Gold goes all the way up to it peaks out around 2011 or so because of all the quantitative easing and the Fed expanding its balance sheet. Everyone was worried about inflation, but it gets a little bubbly there, comes all the way down. Then it's been in this bear market kind of consolidation period until we get to 2020, insert the cerveza sickness. Fed takes its balance sheet up to over $7 trillion. Now gold does bounce around a little bit, but recently it's gone up and up and up till now it's over $1,900 an ounce, at an all-time high in nominal terms, but in real terms, still not at its all-time high yet. Going over to Bitcoin, we have a chart going back to 2012. Doesn't do much. We have this little blip here. That's when it got over 1,000 in 1,400, comes back down. But then in 2017, we had the Bitcoin bubble of all time. In long term, I'm bullish on Bitcoin. I like it as a speculation, but I don't care how gung-ho you are about Bitcoin or how bullish you are, you gotta admit that was a huge bubble. So we get to 20,000 almost and comes crashing all the way down to 4,000, goes back up to almost 12, chops around a lot, volatility. We have the halving. It went down after that. That was kind of buy the rumor, sell the fact. But now we've gone up over $10,000 again. The United States dollar prior to 1980, back actually prior to the 1970s and the 60s, up over 100 on the DXY. Remember, the DXY is just a measurement of the dollar against a basket of other currencies, mostly the euro. So during the 1970s, when we have inflation, it comes down to about 85. I think that's interesting. It didn't go lower than 85. It shows you how strong the dollar was prior to the 1970s. And also keep in mind, this is a monthly chart. If we had a weekly or daily, I think it might have gone down lower than that. I know it went down lower than 80 in 2010, 2011. So in the 1970s, goes down to about 85 on the DXY. Then Volcker, just like we talked about over here, jacks interest rates. That makes the dollar extremely strong. So in the early 1980s, goes up to over 130 on the DXY. That's when they came in with Plaza Accord 1.0. Keep in mind, we could get a 2.0 if Brent Johnson and the dollar milkshake theory is correct. But right now, that theory is having troubles. Doesn't necessarily mean it doesn't play out in the end. So with Plaza Accord 1.0, the dollar loses 50% of its value in only 2 years. Bottoms out in the early 1990s. We have the dot-com boom, which raises the value of the dollar, but then we have the bust in 2000. We have a commodities bull market. Dollar comes all the way down just before GFC. Then it's a flight to safety. So during the GFC, dollar goes up, but then the Fed comes in with all this money printing, brings it back down to its low right around 2010, 2011. Since then, though, the dollar has steadily gone up and up and up. More recently, been in a range between about 101.96, but as of the last few weeks, it's fallen out of that range down to about 93, where it is today. So now we have to ask the question, are these things cheap or are they expensive? Well, first of all, gold definitely isn't cheap. when you just look at this chart. And of course, more on that in step number 2. There's a lot more to gold, Bitcoin, and the United States dollar than just these 3 charts. Whoa, time out. Let me throw you a quick curveball. We talked about gold being relatively expensive, adjusted for inflation, but that's assuming that the CPI is correct. If the CPI understates inflation, that means the price of gold in real terms would be a lot lower, potentially even cheap. So I'm not here to debate the CPI. That's for a completely separate video. But I'll let you think through what you actually think the CPI has been since 2000 and come to your own conclusions on where the price of gold should be on this chart. Looking at a historical chart is always our first step. Bitcoin, not much history. That's why you can't really tell if it's cheap, if it's not compared to itself. Only started in 2012. You could say it's cheap relative to its all-time high, but that was really a bubble. It's hard to determine. I'm going to take a pass on Bitcoin. And again, that's why I think it's more of a speculation, not necessarily digital gold. Looking at the United States dollar just with this chart, definitely not expensive. If anything, it's actually on the lower range. I would call it more cheap than expensive if we're just looking at this chart. And again, there's a lot more to the story. More on that in step number 2. Step number 2, the headwinds and tailwinds for gold, Bitcoin, and the dollar. We start by understanding gold and Bitcoin really compete with the dollar on several different levels. What's good for one is usually bad for the other. So let's look at some charts of the main drivers for these assets. Editor, go ahead and throw up a chart of the Fed's BS or balance sheet. And we all know where that's gone, to infinity and beyond. Over $7 trillion. It's pulled back recently. But I personally think over the next few years, the Fed's balance sheet will definitely exceed $10 trillion. That's a lot of base money that can be turned into additional money supply in the real economy. So that's going to be a huge tailwind for gold, Bitcoin, and a headwind for the dollar. Speaking of the real economy and money, we've got M2 money supply. Lately, the chart looks very similar to the Fed's balance sheet. It's going straight up. It doesn't necessarily mean there's a causal effect, but it does mean that there's more potential for future inflation. And on that topic, I want to look at a chart of excess reserves in the commercial banking system at $3.2 trillion at an all-time high. I want to be clear, this doesn't necessarily mean there's automatically more money circulating in the real economy. It just means that the balance sheets for the commercial banks have more capacity to lend either now or in the future. And remember, the banking system is responsible for the majority of new money supply in the real economy. They're the transfer mechanism. So a lot of that is based on psychology. That's for a whole different video. But the main takeaway is there's a lot of potential. There's a lot of dry powder for future inflation. So another check mark for gold and Bitcoin, another tailwind, in other words, and more headwind for the dollar. But now we look at a chart of velocity, and we can see that that has dropped pretty much as M2 money supply has gone up. And I know Jeff Snyder would say, George, you can't use those numbers. They're totally bogus. And I know that's most likely true, but I'm not really looking at precise numbers here. I'm more looking at trends. And to do that, I think we still can use the data from the Fed's website. But velocity has gone down quite substantially. That means the rate those currency units are circulating in the real economy is getting slower and slower. Why is this? I think Lynn Alden, one of my partners in Rebel Capitalist Pro, has a great explanation. And her hypothesis is because a lot of this additional money supply is going into fewer and fewer bank accounts, the bank accounts of the rich. And since they have a lower propensity to actually spend the money, it doesn't circulate in the economy. I want to be very clear, this isn't an argument to tax the rich and spread it out to the middle class and the poor, because that's going to create even more problems. Remember, There is no free lunch, but it gives us an explanation why that velocity is going down. The slower those currency units move, the more of a tailwind that is for the dollar, headwind for gold and Bitcoin. The US debt, we all know where that's gone, over $26 trillion just on balance sheet. And we know that off balance sheet, the debt is a lot higher. So that's going to be a tailwind, a check mark for gold and Bitcoin for sure. But I want to point out that a lot of this debt the government is issuing with these huge deficits is being monetized by the Fed, meaning they're creating currency units out of thin air, bank reserves, to buy those treasuries from the federal government at auction. I know it happens through a shell game, but the net result is still the same. The base money increases along with the US debt. And the reason this is important to understand is because if the debt was going to 30 trillion, 35, 40 trillion dollars, but is being purchased by Americans with their savings, or even foreigners with their savings of dollars, it would be the same amount of dollars circulating in the system. But if the Fed is monetizing the debt, that means there's more currency units in the system. The question then becomes, do they stay at the Fed in the form of bank reserves, or do they get out into the real economy? That goes back to the commercial banking system and the amount of excess reserves. But the bottom line is there's more and more potential for future inflation as a result of the debt being monetized. So another check mark, another tailwind for gold and Bitcoin. Also, I want to point out that historically, negative real interest rates have been very bullish for gold and very bearish for the dollar. What do I mean by negative real rates? That means if the rate of inflation exceeds the interest rate or the Fed funds rate, that's a negative real rate. So if inflation is running at 10% and if interest rates are at 5%, real rates are -5, although the nominal rates have a positive 500 basis points. I think the main takeaway from step number 2 is because we have all of this base money increasing dramatically, that's kind of potential for future inflation. And the only thing holding it back is just this velocity. It's like this time bomb of inflation that's about ready to explode. And the only reason it isn't exploded now is just because of the length of this string or this wick or whatever you call it. But it's lit. So it's not a matter of if, it's just a matter of when and how long is this wick. And this is just like the dollar, that we start here, we can go down, we can go up, but sooner or later, that fuse, that light, that fire is going to get into that bomb. Inflation is going to explode. So that's why I think it's very safe to conclude that over the long term, 5 years, 10 years plus, there's a lot more tailwind for gold and Bitcoin and a lot more headwind for the dollar. Step number 3. Now we answer the question, what should you actually do? And I can't be too specific because everybody's situation is different. I can't give you investment advice, but I can tell you what I'm doing with my own portfolio and what I suggest to my friends and family members, except friend and family member Fred. We're not giving him any information. He's got to fend for himself. We start with a chart of gold. This time it's not adjusted for inflation. It's in nominal terms going back to 1986. 200 up to 2000. Goes up a little bit, comes down in 1990, and pretty much bottoms out in 2000, and then goes straight up. This chart only goes to 2012 because I wanted to match it up with this one on the right. But in 2012, when we were at the last nominal high, it had gained 350% roughly since 1986. And now, of course, we've exceeded this high in nominal terms. Let's look at this chart. I know it's kind of slanted a little bit. With this dry erase board, I was drawing everything from over here, so I didn't even realize it was at this slant. But pretend this is a nice, clean, straight line. It goes back to 1986 as well, to about 2012. Goes from 0% up to 180%. This is the Big Mac index compared to the CPI. So the CPI since 1986 has gone up by 110%, but the Big Mac index has gone up by 173%. I'm not saying the Big Mac index is perfectly accurate, but I think it's probably more accurate than the CPI. So answering the question, should you buy gold? We have to keep in mind that I don't see gold as an investment. I don't even see it as a speculation. I see it as ensuring your purchasing power. So if the job of gold is just to keep you rich and not make you rich, in other words, the job of gold is just to preserve your purchasing power as a store of value, we can safely conclude that at least since 1986, it's been doing a fantastic job of that. You can buy almost double the Big Macs today as you could have back in 1986. And that's even using the Big Mac index itself. The Big Macs have gone up by 173% in nominal dollars, but gold gone up almost 350%. So the bottom line is gold definitely done its job. That's why I don't really worry about the price of gold. I don't really ask myself if it's cheap or if it's expensive because it serves such a different purpose in my portfolio. I just always buy regardless of price. Now for Bitcoin, it's more of a speculation. So we don't have a lot of history there. I definitely philosophically understand the argument. I love the bullish argument for Bitcoin because it's a more libertarian, it's a decentralized currency. That's what I'm all about. And I think the upside could be 100,000, a million, who knows? Because there's only 21 million Bitcoins that exist, you have a very limited supply. But because it's a speculation, I'm not going to go into it with more than 1% of my portfolio. Let's talk about cash, the USD. The reason why I currently hold dollars is just to keep dry powder up my sleeve in case an asset comes down in value where I'd want to trade my dollars for the asset. And I know the argument against it right now. Of course, we explained it in step number 2, and that's the dollar continues to go down in value while you're holding it. But you have to ask yourself the question, what is the dollar going down relative to? Is it going down relative to consumer goods or assets that I want to purchase? See, I think there's a good probability that dividend-paying stocks that I want to buy with my cash come down in value over the next couple years relative to the dry powder, relative to those dollars. And I'm willing to take the risk short term with those T-bills, just rolling them over. That's where I like to keep my cash. And I'm willing to take the inflation risk to have the optionality to transition and roll over into an asset that's getting cheaper and cheaper and cheaper. Now, whether that's going to be real estate, whether it's going to be stocks, who knows? I'm not sure what it is, but I'm willing to take the risk. So what I would do to limit my downside from that inflation standpoint is I would look at interest rates on the yield curve. And I know that the Fed can suppress them and do everything, but if you see yields at the long end of the curve really start to spike up and kind of get out of hand and the Fed has to buy more and more and more of these things, that's when I'd be more hesitant holding dollars and I'd maybe transition into more precious metals or maybe even Bitcoin if it becomes a lot less volatile. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.